Good evening, ladies and gentlemen. Our session will shortly. We'll just give a couple of seconds, please. Good afternoon, dear members, industry colleagues, and respected speakers. A hearty welcome to all of you to today's web seminar on foreign remittance and MLI impact and GST at 3 hits and misses, organized by the German Engineering Federation VDMA in association with NextGem SKP. We hope all of you and your family and colleagues are safe and doing well. I'm Jamli John, based out of the Mumbai office of VDMA, and I'll be taking you through the session today. The Indian economy shrank in the April to June quarter by 23.9%, an unprecedented fall. It provided the first overview of the extent of the economic damage on account of the outbreak of COVID-19 and subsequent lockdowns. India is possibly the worst performer among major countries. China, now challenging India across the LAC, actually expanded its economy by 3.2% in the April to June quarter. The UK was amongst the worst hit, witnessing a contraction of 20.4%. The US, the world's largest economy, shrank by a manageable 9.5%. Thus, India's situation is unconscionable, as it's also slowed down with the terms of per capita income. The granular GDP data suggests that except for agriculture, which expanded by 3.4%, other job-intensive segments were badly affected. Construction and management shrunk by 50.3% and 39.3% respectively. The bulk of the non-financial services sector, such as hotels and trade, also shrank by 47%. The government must move to revive the economy on a war footing. The first stimulus package focused on creating favorable conditions for banks for the lending purposes. This may not have worked. Fixed investments dropped by 47.7% in the first quarter to rupees 5.99 lakh crores. The only support for the economy came through an expansion of government consumption, which was at 16.35% at 4.86 lakh crore. The way out for the government is to take the lead in reviving investment through public infrastructure projects. This can crowd in private investments and start a virtuous cycle. The center also needs to implement radical economic reforms for sustainable growth. BDMA has been committed to India. BDMA, the Mechanical Engineering Industry Association, was founded in November 1892 and is the most important voice of the mechanical engineering industry. BDMA represents around 3,300, mostly medium-sized companies, making it the largest industry association in Europe. Its members contributing to 78% as exports, which is equivalent to 232 billion euros as production. Knowing the very early significance of India as a future market for member companies, India was one of the first overseas offices amongst the BRIC countries. BDMA is the only German industrial association having well-established offices in India since several years, and offices located in Noida, Kolkata, Mumbai, and Bangalore. Before we continue, I'd like to remind all of you that you should continue to post your questions during the entire session under the questions section, and we will take it up in the last leg of the webinar during the Q&A. For today's web seminar, we'll have the presentation from Mr. Maulik Doshi, who's the Senior Executive Director for Tax, at NextIM SKP, giving us the overview on foreign remittance and multilateral instrument MLI impact and implications. Mr. Saket Patavari, who's the Executive Director for Indirect Tax and Senior Director at NextIM SKP, will address on the GST at 3 hits and misses. My colleague, Mr. S. Manohar, who heads the Southern region for BDMA, will be doing the moderation for the Q&A and also having his concluding remarks. With over 18 years of experience in cross-border tax, Mr. Maulik Doshi heads the transfer pricing at NextIM SKP. He also oversees the transaction advisory services function. A chartered accountant by qualification, he advises multinational corporations on Indian and foreign transfer pricing rules in all contexts, including planning, litigation, and advanced pricing agreements. Maulik has been recognized as a high-ranked practitioner by Euromoney's transfer pricing expert guides. He has with complex advisory requirements across various sectors, including IT, electronics, financial institutions, private equity and asset management, automotive, consumer products, pharmaceutical, medical devices, and manufacturing. Mr. Saket Patavari is the Senior Director at NextIM SKP and leads the indirect tax practice. Saket plays a cross-functional role encompassing the policy advocacy, project management, litigation management, task risk management, business partnering, transaction advisory, and strategic planning. He's a chartered accountant with a lawyer's experience of 50 years, with a well-rounded experience of 50 years, and he has been ideating, implementing several complex tax management projects in his previous roles. He regularly addresses sessions at leading forums, including the Institute of Chartered Accountants of India, Chamber of Tax Consultants, and the National Academy of Customs and Indirect Tax. With no further delay, I'd like to hand it over to our esteemed speakers today, Maulik and Saket. Over to you. Thank you.
Thank you, Jamli. Thank you to BDMA for kind of providing us a platform to provide our views. And on the two most topics that are kind of most relevant right now, a lot of companies are struggling with both GST as well as the remittances, and it's a pleasure to kind of provide some insights and some views and be kind of help to the companies over here.
Thank you.
Over the next 45 odd minutes is that we're going to concentrate on two important aspects. First one is the foreign remittances and the impact of multilateral instrument that has on all the foreign remittances from a tax perspective. And the second was on the GST. We've completed 3 years on GST. So what are the learnings out of that? On the foreign remittances, the main issue that the companies deal with is any foreign remittances that an Indian company makes abroad would have to be kind of for the withholding taxes or TDS to be deducted on such foreign remittances. Now, the area of foreign remittances is much more critical and much more important because the revenue is going outside India, and the tax authorities as such don't have any other recourse to reach out to the recipient of the income to check on the actual taxability part of it. So it is the payer who is put on the dock in terms of the liability to deduct taxes, and if the payer is not deducting the right taxes, the tax authorities are going out and reaching out to the payer rather than to the recipient in terms of collecting of the taxes, etc. So the foreign remittances over the years have kind of become a much more important subject, where even the tax authorities are kind of going and questioning and scrutinizing this in greater details. Before we get into what issues are there and how things can be worked on a simplified manner, I wanted to just get an audience feel in terms of what issues, if any, they are facing right now on account of foreign remittances. So we have a quick poll. Jitin, if you can put out the poll, we want to kind of quickly understand what are the major issues you face while making foreign remittances. Maybe for the next 10 seconds or 15 seconds, you can provide the answers to the poll here. Can you quickly now look at the results? What's the time? Can you close the poll now? Okay, so the vast majority have come back with the question on the banking process in terms of the major issues being faced uh, while banking with the bank in terms of foreign remittances. 30% of the people believe that availability of all documents in one place is becoming a challenge, and 24% believe the receipt of all relevant documents and certificates on a timely manner is a challenge. So kind of it's a great insight. The banking process and the availability of documents can be kind of managed in a much more efficient manner, and that would we'll try and address them over the course of next 20 minutes in the course of this webinar. So we can kind of now start looking at to what are the implications or what are the impact of this foreign remittances, and what is the requirement for withholding tax payment on the payment to non-residents. So like I mentioned earlier, the objective of a TDS or a withholding tax is to ensure that the tax is collected at the earliest point. But at the same time, from a non-resident's perspective, the government's intention is also to ensure that they collect the right amount of taxes without having a recourse to the non-residents. And therefore, they realize the difficulty in collection of tax from non-residents, and hence an obligation is put on the Indian payer to ensure that the right amount of taxes is collected and paid to the government's treasury. To ensure that the taxpayer in India who is making the payment is also complying with these regulations properly, and that they are not kind of confused on the amount of withholding or the rate of withholding to be done. They were provided that a certificate in form of from a chartered accountant in form 15 CB would be required wherever the payment is exceeding 5 lakh rupees in the whole year. So they kind of have provided that it's a double check. Apart from company taking a position on the withholding tax, even a chartered accountant certificate is be required, who would certify that whether the payment is subject to taxes in India. If yes, what rate, and if no, why it is not subject to any taxes. For payments which are not subject to taxes or payments which are below 5 lakhs, there is an undertaking that is required from the company's side, which is in the form 15 CA, that needs to be filed with the banker with all of the banking documents to ensure that the remittance goes ahead. So right from start, the government is extremely cautious in ensuring that the taxpayer applies the right withholding tax rate when the payment is made abroad. Now, if I recap this 20 years back, which was the start of my career, I remember that this requirement for a certificate from a chartered accountant was not there. Instead, there was a requirement to go to a tax office and obtain the NOC from a tax officer for making payment abroad. So imagine a situation where practically for every payment you have to approach a tax officer asking for a NOC, and at that time there was no digitization, no online or e-services from the tax department. So practically going to the tax office every day, if your remittance is to be done on a daily basis, asking for no objection certificate, waiting long hours at the tax office, getting that certificate, and then only the payment used to get processed. So from that, obviously we have moved a long bit, where it's now based on either self declaration or a chartered accountant certificate, and the entire process is online right now. But still, there are two levels of checks that are required before you make the payment on to the non-resident. Next slide, Jitin. So the question is that is there a threshold applicable for the withholding taxes? Like for example, when you make a professional fee payment, there is a threshold of 30,000. When you make a rental payment, there is a threshold of 1,20,000 or 1,80,000 rupees. But in case of foreign payment, there is no threshold applicable. So even if it's a $1 payment or a rupee 1 payment, you need to ensure that the withholding taxes, if any, are deducted and paid to the government. So that's been the major kind of a difference between the TDS local provisions, where small remittances really don't matter, but here even a rupee or a dollar or a euro transaction would be subject to withholding tax provisions. This being foreign remittances, they are focus area in tax assessment. For local payments, the tax authorities know that if they are not recovering from the payer, they can at least recover from the recipient, because both the parties are in India. But this being a foreign remittance, where the other party is sitting in a country outside India, the tax authorities don't have a recourse to recover the amounts from them. That's why it becomes a very important issue, and that's why it's a focus in the tax assessment. If you are not deducting the right amount of withholding taxes, there is disallowance of expense, apart from interest and penalty implication. So it's an extremely important area that if I'm making a payment, I correctly determine the withholding tax rate. To top it off, at least over the last 5 years or so, we have seen that the international tax laws are very complex and ever changing. When India adopted the liberalization and when foreign investment started coming into India, the initial period was static in the sense that whatever tax treaties were entered were kind of stable, and we didn't see so much of changes in the international tax law. But over the last decade or so, we have seen significant amount of changes in the international tax laws, and therefore one needs to be really mindful of the payments that are being made. For example, recently a lot of countries, including India, entered into a concept called multilateral instrument, which I'll be explaining going for in the subsequent slides also. But based on this multilateral instrument, the tax treaties that India has entered with 90 odd countries undergo a change with only one instrument being signed by India. So one earlier used to look at the Indian tax provisions and the tax treaty provisions. Now one has to also consider the provisions of multilateral instrument and take the interpretation out of 3 and then determine the withholding tax rate. And this provision is applicable not only when a resident is making a payment, but if there are two payments being made between two non-residents, but they cover Indian leg of the transaction, if they have a branch office, liaison office, a project office, or some kind of a presence in India. So even if the transaction is happening between two non-residents, but they cover the India leg of transaction, it is subject to the withholding tax rates in India. Next slide. I don't want to go into the penalty provisions and the consequences for non-compliances because I'm sure no one wants to reach at that point in time. But suffice to say that amongst the world, India has very harsh penal provisions for all non-compliances under the Income Tax Act or to that matter, even the indirect tax law. So there are penalties of 1 lakh rupees if you don't furnish the Form 15C or CB to the tax authorities, the CA certificate or the declaration to be filed by the company. Like I mentioned about interest and penalty, other than this 1 lakh rupees, and there's also a disallowance of expenses where taxes are not properly withheld. Next slide. So let's look at how the withholding tax process works. What are the components it goes? How do you determine the right withholding tax rate? So obviously the first thing is to find out what is the nature of payment that I'm making. What is the classification of the payment? For that, I'll have to review the documents, the underlying documents, which will be the agreement copies or copies of invoices or purchase orders, the likes of those. So once I look at the documents, I determine the nature of payment, which is in the nature of royalty or fees. Is it for the nature of services or is it payment for dividends, etc. Once I do that, then I need to check whether the foreign party has a permanent account number. If there is no permanent account number, then there is a penal rate of 20% withholding that is applicable. Though the government has relaxed that in the recent times, where they have provided that if the foreign company provides a tax residency certificate, Form 10F, Rule 37BC, declarations, etc., then the 20% rate would not apply. Then the next step is to check the taxability under the Indian domestic law, whether the payment that is taxable under the law, Indian domestic law, whether if yes, what is the tax rate. Then you check the taxability under the tax treaty, whether they are taxable and if it was tax rate, including, like I mentioned, the impact of multilateral instrument, which has been effective from 1st April 2020 for India's tax treaty with several countries. So once you determine the tax rate under the Indian domestic law and under the tax treaty read with the multilateral instrument, we need to decide the right tax rate based on the above two steps and whichever is more beneficial to the taxpayer. So if we believe that the Indian domestic tax law is more beneficial and the tax rate there is say 5% as compared to the tax treaty rate of 15%, then the 5% rate could be applied. At the same time, if the treaty provides for a 5% rate as compared to the domestic law of 10%, then the treaty rate could be applied. So whichever is more beneficial to the taxpayer would be applied, and accordingly a withholding tax rate would be determined. So this is how the process works in terms of steps, where you need to, right from understanding the transaction, the underlying, looking at the underlying documentation, to the determination of the withholding tax rate, the entire process would be carried out to determine the right withholding tax rate. Now, this was all applicable for all payments that were being made, which were in the nature of services, purchase of goods, royalties, management charges, corporate charges, etc. With effect from 1st April 2020, the dividend payments are also now taxable in the hands of shareholders. This is a new tax regime on dividend. Earlier, the dividends payments were getting taxed or being paid by the company distributing the dividend in the form of dividend distribution tax, and the recipient, which is a shareholder, would not have to pay any taxes. But from 1st April 2020, the dividend distribution tax is abolished, and the shareholder will have to be paid tax on their tax rates. For resident shareholders, it would be based on the tax rates that is applicable to them. But for non-resident shareholders, the withholding tax would be 20% as per the Income Tax Act. But again, like I mentioned, this is step 3 in the chart earlier. The step 4, you have to go to the respective tax treaty, determine what is the tax rate under the treaty, subject to the availability of all the documents, subject to the reading of multilateral instrument, and accordingly, if the lower rate is provided under the treaty, the lower rate would apply. So even the dividend payments that are now going up from Indian companies to their parent companies, to their shareholder outside India, that needs to be checked for the withholding taxes, and the compliance would have to be undertaken. Next slide. So before we determine whether the tax treaty benefit is really available and whether the lower rate under the tax treaty is available, one needs to check for 3 or 4 criteria, because over the years, lot of multinational corporations have taken advantage of the tax treaty network that was there earlier, and have set up their transactions and structures in a manner that they kind of try and do the tax planning exercise and try and minimize the taxes. To kind of curb this behavior of the multinationals, G20 countries along with the OECD came out with the entire base erosion profit shifting project, and they have kind of tried and plug all the loopholes that were available for which were used by multinationals to kind of plan their affairs. And one of the aspect is the multilateral instrument, where they say that the treaty benefit is available only if the recipient is a resident of that country and he has substance in that country. And by substance, we mean that he is doing his principal business in that country, and he's not just merely a holding company or merely a kind of a post box company. So that is the impact of the multilateral instrument. All the relevant documentation to ensure that the person has substance in that country, and the person is a beneficial owner, he is a tax resident of that country, should be available, and all the documents should be in place. The treaty benefit also can be denied if the tax authorities believe that the general anti-avoidance regulations which are there under the Indian law, the treaty benefit is being taken to just to kind of outweigh the general anti-avoidance regulations. So the tax authorities under this GAR rules can deny the tax treaty benefit which is available to a taxpayer if they believe that the tax treaty benefit is being taken not in the right manner and not for the purpose which with the tax treaty was entered into. And one more important thing is that while India has entered into a lot of tax treaties, and this is true for a lot of European countries, most of the tax treaties contain most favored nation MFN clause. Under the MFN clause, so for example, if I'm making a payment to Sweden and the India-Sweden tax treaty provides for a tax rate of 15%. At the same time, India-Sweden tax treaty also provides that if India enters into a tax treaty with any other European country or with any other country which is a part of OECD and provides for a tax rate lower than 15%, then the same benefit would be extended to India-Sweden tax treaty. This is the most favored nation clause. And if after the India-Sweden tax treaty, say India has entered into a tax treaty with France and the withholding tax rate there is 5% or 0%, then the same benefit would have to be applied to the India-Sweden tax treaty. So these MFN clauses generally are kind of very hidden in the tax treaty, and it's very difficult to look at that or interpret them. And therefore, it is very important that one really analyzes the MFN clause under the tax treaty, analyzes what all tax treaties India has signed after the home country, and then take a benefit according to whichever is the most beneficial provision. So most companies or most places, people kind of miss out the MFN clause because, like I mentioned, it's not brought out so prominently in the tax treaty, and one needs to really interpret to ensure that the benefit of MFN clause is available. Next, so these are some of the kind of issues that one needs to look at while granting the tax treaty benefit. Next, we are going to discuss what are the typical challenges that are being faced by the corporates. Some of the challenges you kind of brought out on the poll that we did at the start. But the most important challenge is obviously to determine what is the correct rate of withholding taxes. Like I mentioned, every tax treaty is different, and the rate of taxes would vary from tax treaty to tax treaty. And to that extent, determining the right withholding tax rate would be very important. If there are kind of significant amount of protected litigation on certain payments, like payment for software or payment for database usage, subscription payments, training payments for training services, a lot of these have a controversy going on for lot many years, where different courts in India have taken different positions on how these payments have to be treated and what is the withholding tax rate applicable to these payments. So these kind of payments, especially software, database access, subscription charges, charges for any digital payments, e-commerce transactions, have been kind of subject matter of our litigation, and one needs to examine that more thoroughly. The documents and details would have to be maintained for a period of 8 years, and when the assessment or assessment proceeding comes in, or the tax authorities start questioning that 3 or 4 years down the line, at that time documents must be available. Now we have seen this is the most common issue, where most companies don't have the documentation when it needs to be presented to the tax officer 3 or 4 years down the line, and one has to scamper for it at that point in time. So the availability of documents and details at the time of assessment is also extremely crucial. The turnaround time generally takes a longer time because multiple stakeholders are involved. There's a tax consultant who will help you with the determination of withholding tax rate. The tax team of the organization would get involved. The accounts payable team of the organization would be getting involved. Obviously, there are bankers through which the payments are being made. So the turnaround time of making the remittances also sometimes increases if there are multiple stakeholders involved, and for urgent payments that becomes an issue. So these are typically the challenges that are being faced by corporates. We can go into the next slide. One way to look at these challenges is how do you kind of ensure that these challenges are minimized and I get a optimal turnaround time. I be able to present all the data and documents to the tax office as and when required, and the withholding tax rate that is being determined is accurate. So one way is to look at whether the entire process can be automated. A lot of companies right now follow manual processes. Manual processes can be cumbersome, especially if there is a larger volume of the foreign remittances. We have seen companies which are having remittances from 2,000 to 20,000 in a year, and those kind of remittances to be handled on a year-to-year basis manually is going to be a challenge. Again, manually would require more larger turnaround time and kind of more time for processing the certificates and forms that are required to be filed. There are obviously chances of errors in punching of data, etc., which can be taken care if you're looking at an automated system. And the entire time that is being spent by multiple stakeholders can be reduced by looking at an entire automation of the entire process rather than doing it manually. So obviously automation, like in any aspects of business, is an important key on the tax aspect and also on the foreign remittances that we are talking about. We go to the next slide. So basically, on the automation side, there is a tool that is being developed by NextDime, by us, which helps the entire process on end-to-end remittances. It is an automated system which is combined with the experience from our side on the tax experts. It helps in easy generation and uploading of multiple forms, 15CA, 15CB, as well as a lot of banking documents. Now, each and every bank would have a different kind of banking documents. Some are requiring a letter along with the form A2, and some other require some request letters, etc. So a lot of those banking documents also can get generated out of the automated tool, so that manual efforts are not being spent there. You get a kind of customized repos from the tool. There's an online repository to save all the data and documents. So 3 years or 4 years down the line, when you have to look at providing the data, it can be downloaded at a click of a button and given to the tax authorities as and when required. So you don't have to kind of worry about the data availability part of it. You don't have to worry about kind of high attrition or turnover of employees in your organization, because the data is safe and secure, and at any point in time it can be accessed by anyone who has the credentials to kind of log into the system. It's a very friendly system, friendly user face, and it is a real-time reporting of all the reports, dashboards, etc. available. And this process is entirely handled in a very efficient and a time efficient manner. Next slide. So this was what I wanted to talk about the foreign remittances. The issues are very complex. It requires attention and details. At the same time, the manual processes are going to be making things more and more difficult as we go along. And therefore, every company should look at how the processes can be automated at their end, even if it's kind of not necessarily using NextDime's tool, but even if at your end, how the entire process can be automated, so that there is a efficiency being brought into the entire process. I'll now hand over to Saket to take us through the GST part of it. We mentioned at the start, we'll be taking question and answers together towards the end of the session. So once Saket completes his presentation on GST, we'll be taking all the questions together. So over to you, Saket.
Thank you, Maulik, and good evening, everyone. So it's been 3 years that GST has been rolled out. So these 3 years have been, I'm sure, quite eventful. At least it has been eventful for any indirect tax professional in the country, and also a lot of businesses who are involved into indirect taxes, rather who are involved into compliances for indirect taxes. It's been really, really eventful. So that's the topic for today for me. It is GST at 3, hits and misses. So in last 3 years, let's see what we have done well, where we have missed out, and we could do better probably in future. So there's the topic. Okay. Jitin, next slide, please. So before we discuss the hits and misses, let's see what was the objective objective of implementation of GST. Yeah. So why GST? Why was there was a need for having GST in the first place? See, let's go back a few years ago when in India, when we had multiplicity of taxes. India is a federal country. Even in taxation, we had a federal structure of taxation where there were certain taxes, indirect taxes, levied by the central government and some by the state government, such as central government taxes include central excise, service tax, and insofar as state government includes VAT, entry tax. Earlier it was sales tax, then VAT, and then entry tax and CST. Now, if you saw India, that means since the taxes, some of the taxes were levied at a state level, which meant different states can have different rates of tax for a particular commodity. Some had entry tax, some did not have entry tax, which resulted in maybe different countries within a country, different markets within a country. So therefore, this obviously meant that anyone who's setting up shop needs to also look at what are the taxation structure in that particular state, which is not a right way for taxation, or which is not the best method of implementing a taxation. That ideally tax should not something which should participate in the decision making of where should the business be set up. So tax is just a consequence. So this was one of the main objective of having a single common market, so that across India we have one taxation. So tax does not become a decision factor for setting up the business. That was one objective, or rather the main objective. Second biggest objective, or the main objective, was minimal cascading. Now, as I said, there were different taxes which was levied at the central level and at the state level. Now, these taxes, obviously, there was no cross credits available between central and state. And within the state level, while in the central taxes, it was mostly creditable. Excise duty and service taxes were creditable crisscross. But if you see state taxes, it was not creditable. VAT was creditable, but say entry tax was not creditable, and there was no crisscross of taxes credit available between center and state, which again resulted in cascading of taxes. For example, if there is a retail chain hiring a space for its retail store, it will not be allowed a credit of service tax on the rent that it pays, which would have become a cost to be factored in. So therefore, there was cascading of taxes. Third objective was simplified tax structure. With so much of multiplicity of taxes across India, this was needed, because for a taxpayer to undertake compliance at a central level, then to at a state level, assessment at central level and a state level across various multiple taxes like entry tax, VAT, service tax, central excise, etc. So this was one of the canons or the objective of having a simplified tax structure. The fourth one is a bit controversial, where they say simplified compliances. Well, when we saw these objectives initially, and when we saw the GST implementation, which we'll see more detail when we discuss the hits and misses, but I think we all would say that compliances, that these taxes are anything but simplified. So these were the basic objectives of GST. So before we get into the hits and misses, before I say about my perspective on hits and misses, let's if we can have a poll on what do you think basis GST, whether we have been able to successfully do, whether GST is a success in the country or no. So there's a quick poll. Please select your options, and then we'll see what does the audience think about it. Oh wow. So almost 71%. It's a thumping yes that GST has been successful. 11% feel no. 18% probably are in the not sure whether GST has been too successful, or it's maybe early times to gauge whether GST is successful. But vast majority of the team here feels that GST has been successful. Fine, let's see. Maybe we'll come back to this at the end once we have discussed the hits and misses. Next slide, please. Yeah, let's see what were the hits of GST. So this broadly are the hits. Let's go to the next slide where we discuss individually each one of them. Right? Yeah. First one is one nation, one tax, one market. As I mentioned earlier, the objective of GST is tax should not be a factor for which for deciding where do you have your business in the country. Indeed, I think GST has been successful in having one nation, one tax, one market. Today, when you do an interstate transaction, irrespective of where you do the transaction, whether it's a local transaction or interstate transaction, the rate of GST qua commodity or qua service is same. So therefore, it certainly has brought across the whole India into as one nation, one tax, and one market. Believe me, it was not easy for the government to do that because of taking away or taking out of this federal structure, coming into one nation, one tax, and one market. As we can see, there has been and the government has really taken a lot of pain to have this done, and eventually we have been successful in doing that. Second one, reduction in cascading. This also was one of the prime objective of GST, because cascading of taxes means what? The tax is on the business. Business is bears the tax. Ideally, it's an indirect tax. Indirect tax means the tax is indirectly borne by the end consumer. So actually, the tax has to be borne by the end consumer, but however paid by the businesses, which which are basically more of an agent, I would say, for lack of better word, for collecting those taxes and paying to the government. So certainly it has, I think, GST, because of the seamless credit barring few items where credit is denied, I think we have achieved the objective of being reduction in cascading of taxes across India. Next slide, please. Yeah, widening the tax base. Indeed, this was one of the things that we were envisaging, that there will be a, if the tax base does not get widened, then maybe somewhat reduction in taxes which were imposed would have been a bit of challenge. But certainly we have seen since the first Q2 of 17-18, Q2 is basically, it would have taken some time for people to get registered in GST. So if we saw from Q2, when we compare the current period, we have got, there is a 40% increase in the registered taxpayer across India, net increase of 40%. And now today, from 70 odd lakh GST registered taxpayers, today we have 1.23 crores of GST taxpayers. And the increase is, and the 50% are newly registered out of it, which means 50%, as I said, 60-70% lakhs were already there. So balance is, that is, there is a 50% increase in newly registered taxpayers. What it indicates is lot of businesses which were earlier what we call colloquially as kacha business or kacha or black market have come into formalization, and you would have seen across your across the board, a lot of people have indeed come into GST chain, which earlier they may not be in the chain. Certainly it has taken to the economy to more towards formalization. What it has also done is, interestingly, our Prime Minister also mentioned in one of his speeches that GST has led to increase in income tax collections because of formalization of the economy, which I think is an accurate statement that yes, indeed it has resulted in income tax collection as well. And that's a few of the things that both CBIC and CBDT, Central Board of Indirect Taxes and Customs, and Central Board of Direct Taxes, they have signed MOUs for exchange of information, etc. So in future we would see a lot of data getting exchanged. And in fact, in the returns also, in the income tax returns also, there are details that needs to be filled from a GST standpoint. So we'll see a lot of widening of tax base, not only relating to indirect tax, but probably also in future for income tax as well. One of the hallmarks of GST has been government's responsiveness to representations. While all these years, and that's been even my experience so far during the GST times, pre-GST, yes, government used to kind of used to listen to the representation by the various industry forums, etc. But with GST coming up, this was a new law. Government was really open to understand the industry challenges, industry's apprehensions for were even adaptable to make certain changes in the law as it was needed. Personally, also we have seen I've seen cases during my last organization where we, as a representative, when I was part of various delegations to the government across India and across various states, their approach was more receptive in terms of getting to understand the issues, and basis that they may or may not have done a lot of stuff in terms of changes, but certainly they've been very considerate in understanding the issue, and in some points things which were impacting the industry at large, they have taken actions. For example, we would have seen a lot of deferment of period of compliances. Our GST credit eligibility in the first year, they extended by one more year. Instead of September, it was till March 2018, they allowed it. So all these things were part of, because they understood the pain points, because they were responsive to what the general public at large felt on GST. So they were really responsive on how the GST, on various representation that was made. Next slide, please. This is probably one of the most interesting feature of GST, and from GST, is being socially active. Now we all know that, and we all are aware that today, GST, before we get a notification, before we get anything, what we get is a tweet from the government about the things that is going to come up, which is very, very interesting and very, very fast. Government is really getting really fast by using social media and getting information through a tweet. Earlier, if I remember those olden days where where for in GST, and mind you, indirect tax is a transaction tax, so there are changes need not come in budgets. It can come anytime during during the period. I remember once there was cess, there was social there was some cess imposed. I remember the date also on 15th of November, wherein just 6th of November, just before Diwali, there was a cess introduced, and we all came to know because on the Friday, and that too on a Friday evening, we got to know of a notification implementing cess from 15th. So that instead of those reactive and people getting a shock, now what happens is we get a tweet from the government informing us in advance what's going to hit us, and then we see a notification to confirm that this is going to hit us, which is very, very interesting. And I think that's the new age way for the government to be connected to the general public at large. Next slide, please. So while these were the hits on GST, let's also see what were the misses of GST. Okay, and these are the broadly the misses. We'll discuss in detail in the next slide. Yeah, first one is technological glitches. Now, mind you, GST, the ambition in GST for compliances has been is a Herculean one. What they are never before, I think, in any country in the world, while a lot of countries have done similar kind of stuff in terms of compliances, but India, with the kind of population, with the kind of taxpayer base that it has, having a solution, having a compliance which involves transaction level reporting and doing and matching of credit between the supplier and the recipient of tax, or between two B2B entities involved in the transaction, was certainly a mammoth task. And therefore, it obviously, since it was such a big task, it resulted in a lot of technical glitches. I remember in my earlier organization, we had a humongous volume of GSTR1 when we had to file, and every single return during the initial phase seemed like a project in itself. And obviously, because of the challenges that we face in technical glitches from the GSTN portal. However, having said that, today if you see, I think a lot of it they have addressed, and a lot of challenges have got reduced. Yes, there are still a lot of challenges that is coming up while we file our returns, but they have done, I think, they have done a decent job in terms of the reduction in challenges. Having said that, we are now seeing a lot of changes, radical changes in the GST compliance framework, in the e-invoicing, new returns, which may again throw up new technological challenges from GST and ends, and probably we'll have to see how, to what extent the GSTN or the government has been able to mitigate that. The next one is tax controversies. Obviously, it was a new law. It is expected that any new law, there'll be tax controversy. If I have to just take a cue from the earlier new law when it was introduced, I think probably the last one was maybe a VAT, or maybe let's take service tax in 1994, when the service tax was first introduced. When we were into litigation, when I was doing litigation during initial stage of my career, up to 2010, we didn't see much of service tax litigation coming up. It was more in the central indirect tax, it was excise and the customs. But when we see now, but then from 2010, service tax really picked up. Today, service tax litigation in the indirect tax is much more than what we have in excise and customs. But if you see in GST, it's been 3 years, and within 3 years, we have seen a humongous amount of cases coming up in GST, and that too at a writ level, because of various controversies, various challenges, try and win challenges, your credit challenges, etc., which was not anticipated. But certainly there is a lot of contradiction or controversy that is coming up in tax in GST. And one of the big reason of these controversies is the AARs, and that probably we have to give because we have the federal structure. So both center and state have the have the power to do certain stuff. So therefore, different ARs at a different state level giving contradictory rulings, which is a bit of a challenge. And one of the classic example is whether GST is applicable on director fees or not, which we have seen there are contradictory rulings, creating confusion across various taxpayers. Probably when we have a centralized AR, this may be mitigated to a large extent. One of the challenges is we don't have a GST appellate tribunal, which means today if we have if there is an order from a commissioner, we don't have a choice but to go to the higher court, high court or the Supreme Court, there, because we don't have a GST appellate tribunal, which I think 3 years is a long period of time to have this set up. Given the controversies that are coming up, I think it's a necessity that we have a GST appellate tribunal also set up as soon as possible. Next slide, please. Yeah, as I already mentioned, transitional credits. This is something which government should have been more. Government could have been more pragmatic to the industry. They did not allow or rather they are of the view the cesses that got the accumulated balance of cesses credit will not be allowed to the taxpayers, which I feel that it's a bit harsh. Cesses were, if the cesses were earlier creditable in the service tax and excise regime, and so therefore they should have also been creditable, or they should have been allowed as transition in the GST. While initially the law was not too clear, or was in that sense indicated that credit is allowed, but they have made a retrospective amendment to deny this credit, which is obviously which is also in challenge before the High Court. But that is something which is probably a bit negative in terms of pragmatic approach of the government. The second one is substantive right of procedural lapses. Another controversy which is in the which on the transitional credit is people who have missed out transitioning credit or filing Tran 1, they have been denied the credit by retrospective amendment, while the high courts have been quite pragmatic in allowing the credit, which I think could have done for these procedural lapses, substantive rights should not be denied. Next one is complex compliances. Yes, this is for compliances, while this was one of the objectives that the compliances should be simplified. Today, if we see, certainly compliances are not simplified by any chance. For example, a service provider who earlier in service tax regime could take a centralized registration and file only 2 returns across India, having a pan-India operation. Today, if he has operation in 30-35 states, he'll have to file 750 to 800 or 850 returns across India, which has multiplied. So the compliances has multiplied several folds. Also, because it's not only the number of returns, but what you get into the returns. Earlier, I had to give a total of whatever is a taxable liability. Now I have to give a transactional level reporting. Plus, as I already mentioned, my experience, it's been a nightmare initial few months to do a transactional level reporting when the volumes are very, very high. Then reconciliation with this TSTR 2A credit reconciliation was probably was a very remarkable feat to avoid fraud, GST credit fraud, or VAT credit fraud, which is there across the globe. These kind of frauds are prevalent. To avoid that, this was one of the things that the government has set up, which government itself failed and had to extend it sine die, because the government portal could not handle the credit reconciliation. But what it left with is the taxpayers to do credit reconciliation, because otherwise we used to get notices from the government on asking us to reverse the credit, because as per the government portal and as per the credit available taken by us in 3B, there was a big difference. So that resulted in us to do a GST 2A reconciliation, resulting in increasing or multifold increasing the complexities in the returns that we file. Certainly, the complexity between reconciling between the financials records and the GST return filing where the the methodologies are different, is also a challenge that most of the big players, at least, and I'm sure most of the players, and especially the big players, are facing to a very large extent. So certainly compliances have become complex.
I think we're facing a small technical glitch. Ladies and gentlemen, request you to just give us a few seconds.
Am I audible?
Yes,
Jamli,
Saket,
am I audible?
yes, you're back. Thank you. Yes.
Okay, not sure how did this happen. So sorry, can Jamli, was I audible when I spoke about compliances complexities?
Yes, to a certain extent, yes. Maybe just the last ending part, I think we missed, just for like a
Okay,
couple of seconds only. Right.
sure. So what I was okay, then let me just recap that. What I was stating is, I remember those days when we all know that when we used to write our accounts, we had manual method of accounting where we used to write on on some on our khata, what we called as, or accounting books that we called, and then the computer or ERPs came in, and how things became more simpler while the complexities of business increased, but things became simpler. Similar would be the state during even in maybe in GST compliances, where because of technological advancement or advent of technology, the compliances may become simpler in in days, in times to come. But the way the compliances are, those are going to stay. So inherently, it will be complex, but maybe because of advent of technology, it may become simplified, or it may from a user experience point of view, or from a taxpayer point of view, it may be simplified. Next slide, please. The last one of the misses that we have taken up is delayed refunds. While in GST there was a lot of promise made that the refunds which are due will be provided in maybe 7 days time, 14 days time, 90% of the refunds will be provided. But at a ground level, the experience was not so. There was obviously at a intent policy level, intent was there, but at a practice level, it was not there. Primarily because the taxpayer in our country, they take a hat of a policeman where they see everyone is a criminal and they need to prevent crime. So they proceed on a premise that refund, unless they are satisfied, are unless they are satisfied that the refund is eligible, refund is a it's a fraud, which probably resulted in delay in filing disbursement of refund. Many a times interest was also not given on delayed filing of returns. However, while we have said this, last few months because of COVID, we have seen a different. We have seen indeed the government has been really being conscious about the refunds and what the industry has gone through, and therefore has been a really has taken a pragmatic approach and disperse a lot of refunds. So we have seen, at least from our for our clients also, we have seen a lot of refunds getting dispersed in last few months, and the government also made this as a statement. The finance minister had made this statement, and a lot of people in the government made this statement that they have an intention and they indeed did that and granted us refund in last few months, the things have been a bit different. Next slide, please. So this was hits and misses. Before we wrap up, let me touch upon what's going to hit us soon. What's coming up now in GST? After 3 years have happened, what is it that we expect now? One of the big things that we would expect in GST now coming up is departmental audits and investigations and inquiries. Now that's true for indirect tax. We have already seen in the past things coming up like this, after this compliances are formed, the audits happen. But now in GST, it will be the first time when we have operations in state and center, and the center plus state, while we were audited, investigated, scrutinized by state authorities and the central authorities separately. Now probably we'll have one or maybe both at different setups coming up. Say a DGGI investigation may come up across India, and a state jurisdictional officer, central plus state jurisdictional officer, may come up for an audit and investigation. So result in multiple audits, investigation, and scrutiny coming up, and we may have to explain things, especially for service sector, because the state authorities, if they have the jurisdiction, may not be able to understand or may not be able to, and will take some time to understand the services queries, services concerns. So we may have we'll see a surge in departmental audits, investigation, and scrutiny. Second one is e-invoicing, which again is a mechanism to avoid evasion of taxes, to see to it that credit frauds do not happen, which is prevalent across the globe, so that whatever credits that you're taking has passed through the scrutiny of the government at a prima facie level, is going to come. Today it's from 1st October it is for companies with 500 crore plus turnover, but I'm sure over a period of time this will be phased manner. It will come up for all the B2B transactions, that e-invoicing will be a norm, and a technological solution or a technology advent would be required to undertake this. Third one, as I said, surge in litigation. While GST, because of subsuming of various indirect taxes, would avoid a lot of litigation between services and VAT on the intangibles, for example, on maybe SIM card, for example, will reduce a lot of litigation. But certainly it's a new law, it's a nascent law, and we've already seen surge in litigation in writs and all, and we are going to see a lot of litigation coming up in GST. Keeping on a lighter note, keeping all of us here relevant for all the tax professional in the country, either in the industry or in a consulting firm like us, relevant, or a litigation firm like us, relevant relevant to earn our bread. The next thing is 2 slabs of GST. Well, this is probably one of this would really simplify a lot on GST, but this would also mean at the same time that maybe a 5% slab may go up to some extent. So things which were taxed at 5% maybe taxed at a higher rate, and things maybe at a higher rate, maybe at 28%, like automobiles and all, may come down, or maybe a telecom or any other service. Generally, the mean rate of 18% may come down. So it may be a good or bad, but overall it will certainly simplify the taxes in India when we have 2 rates, 2 slab GST. But doesn't seem like it will be a recent or a it will come out soon. May take some time for this. Last one is mitigating cascading effect. I think we may see in some time petroleum, which is already part of the GST law, at a later date was supposed to be subsumed. Petroleum, diesel, which are not part of GST, and therefore there's a cascading effect. We may see them to be part of GST, and probably the government may allow, all the chances don't see much, may allow the credit of petroleum, which was earlier barred in the excise and the service tax regime, to be allowed in GST, which will really mitigate the cascading effect of taxes. So that's it. I think that's it from me on GST. We can, Maulik and I can take questions on both income tax, in the foreign remittance, as well as on GST. Thank you, everyone.
Yeah. Thank you. Good afternoon, participants. So we had two wonderful presentations from Mr. Doshi on MLI, multilateral instrument, which is which is very much required today because of the increasing international trade, and also GST, what to do next, or what is next from Mr. Patwari, who also explained what was the misses and what is the expectation in the future. Yeah. So to start off the questions, the first question I'd like to ask Mr. Malik. Mr. Malik, you had talked about most of the remittances, that on impact of the remittances from India to outside non-residents. So there was a question across which was raised. What about inward remittances to India? Does it impact in the same way, or is it different?
Yeah, so the inward remittances also are to some extent impacted because of the multilateral instrument. Because multilateral instrument, in a saying, changes the tax treaty that is currently there. The essence of multilateral instrument is that there were certain loopholes in the tax treaties or certain outcomes that the nations didn't desire, but it did happen. The countries wanted to close those loopholes. Now, rather than India kind of negotiating with 90 odd countries separately, the OECD said that we are going to prepare a multilateral instrument. All the countries that sign are agreeing to these provisions that are there under multilateral instrument, and those are affecting your respective tax treaties. So, for example, India has signed, Netherlands has signed, France has signed, UK has signed, and many other countries have signed that. So now India-UK tax treaty or France tax treaty would be read along with the multilateral instrument, and there are provisions which are affecting inbound investments also, the inbound remittances and inbound investments also, and that also one has to go to the multilateral instrument and see what is the impact on that. For example, no longer one presume that holding companies jurisdictions in countries like Mauritius or Singapore or Cyprus would be kind of easily available, because a lot of aspects with respect to holding companies have been plugged in the multilateral instrument. So if a foreign company is wanting to make investments in India through a holding company, they will have to first study the MLI and see whether it is feasible or not feasible. So both inbound and outbound are affected.
So both are parallelly affected by this MLI. Even India is involved across. Thank you for that. And there was another question. Will surcharge and cess are applicable on the DTA? There's a double tax avoidance agreement. Is it applicable, surcharge and cess? I don't know.
No,
is there anything particularly?
Sorry, last part I didn't get, Mr. Manohar.
Is this information is adequate, or you need more inputs to answer this question?
This is it. No, this is quite a common question. The rates mentioned in the tax treaty are final rates. There is no further surcharge or cess applicable on that rate, which are there under the tax treaty. So the tax treaty rates, if it's 10%, it is 10%. No further surcharge, no cess.
Okay, thank you. I think I'll come to you now, Mr. Saket. So let's. There's a question across. Mentioned that there will be. You mentioned in your presentation that there will be audit from both central and state authorities. So the question is related to whether the audit is it not based on allotment of GST? That is, if that company is under central allotment, so one of the officers for or all from CGST, IGST, and CGST would meet them or audit them. What is it?
Yeah. Okay. See, government has the jurisdiction, either it's a state authorities or the central GST authorities. There is one single jurisdiction given to the taxpayers. So, for example, let me give you an example. What may happen is, say you are into a state jurisdictional officer. And the state jurisdictional officer will come and audit you because as a normal, because it's a jurisdiction office, jurisdictional authority. But at the same time, there are different agencies of government who are there for preventing evasion of taxes. For example, we have the DGGI authorities, Director General of GST Intelligence. Now, these are the job of these authorities are to plug taxes wherever they feel there are evasion of taxes. What may happen is, while you have a state jurisdiction and that guy will come and the state officers will come and audit you, we may have separate DGGI investigation on the company or on certain transactions across India basis for for various to the taxpayer. So you may have a multiplicity of investigations and audits. What I mentioned is, while audit will be at a jurisdictional office, but an investigation can happen across India, across various government agencies like DGGI. Plus, there is a Comptroller Auditor General of India who does an audit for the tax offices. Now, this audit, when it is done on the tax offices, it is actually an audit on the taxpayers for the tax offices audit. So that's just different. So while GST, we have one jurisdictional office, but we may be surrounded with questions, queries, inquiries, investigation across multiple agencies at central and state level in GST.
Okay. And another very common question being raised is, considering the decline in GST revenue, should the industry be ready for a GST rate hike or a reduction?
That's an interesting question. See, government's intention, if you saw last year's the GST Council meetings and all, December 2019 and all, their intention is not to increase taxes, okay? Because they are looking at more of broad basing the taxes. People who are the black economy, they want to get more and more into the formalized economy so that they don't have to increase taxes, and the current level of taxes or maybe a reduced level of taxes may work, okay? Except I think the state of West Bengal, except all of them are of the same view, but rather most of them are of the same view. But if you see today's scenario, as you rightly pointed out, because of declining revenues, primarily because of lower surge in the transactions or the economy because of COVID, and increase in government spending because of COVID, and otherwise to revive the economy, looks like, if not a rate hike, which may not be there, but certainly a COVID cess, similar to something like Kerala cess, which was imposed some years ago because of Kerala floods. We may certainly see a COVID cess being introduced. Maybe not right away. Maybe once the economy gets a bit on a recovery mode, we may see a COVID cess being imposed.
Oh, good. So let's look at. I think we'll take the last question for each of you across. One of the other question is that's applicable is, what are the taxes? What are the treaties that would be affected because of MLI, and which are the treaties that would be impacted because of this? Would you answer that, Mr. Doshi, please?
Yes, so pretty much all of India's tax treaties, the answer is very simple, except United States, because US has kept itself outside the MLI provisions, and therefore the United States tax treaty does not get affected. But pretty much every other European nation, every Asia Pacific partner, so all the larger trading partners of India, their treaties are getting affected because of the MLI. The list is pretty long, of almost 78 to 80 countries that are there, and the list keeps on adding. So more and more countries are keeping on adding to the list.
Okay. I think I am forced to ask this question because it just popped up. Time limit to close IDPMS and EDIS import payment. The import data processing mechanism systems. Hello?
Yeah, is that for Saket?
It's for, I don't know, either of you can take this up.
It is, I don't think it has to now do with anything to do with GST or indirect taxes.
Yeah, indirect taxes, fair enough. So we will try to ask that person to provide more inputs on this. So finally to you, Mr. Saket.
Yeah.
You also mentioned that we would be coming up with a lot of common invoice number. I mean, there's going to be invoice numbers raised commonly across in the new portal system, and that would ease a lot of issues. So when would this happen on the GST portal, and how soon it would be across?
The e-invoicing?
Yeah, e-invoicing.
See, e-invoicing, certainly from 1st October, it is already introduced. It's for companies with a turnover of 500 crore plus, and or a phase period. Maybe in once they see how this is gone, whether if it's a success, where this implementation of e-invoicing there, then maybe in next in a phased manner, probably next 6 months to 12 months, if it is successful, it may get rolled out across India. But certainly it would, what this e-invoicing mean is the transactions that it will not simplify things to, at least in the beginning, unless we have a technological solution to handle it.
Okay.
Because what it does is you have to send. So today the difference would be that today if I have to raise an invoice on my customer, I need to have the data sent to the government NIC portal, get an IRN generated if it's a B2B customer, print that IRN on my invoice, and then send it to a customer. To give you an example, suppose tomorrow you go out of a hotel and you want to check out and you have a flight to catch. If there is a problem in the NIC portal of the government and you don't get an IRN, then the hotel will not be able to issue an invoice for you to make the payment. So this this is something that may come up. So that would probably, unless we have robust technological solution, it will result in it would be a bit challenging for taxpayers to handle such compliances.
All right. I think, thank you, Mr. Doshi and Mr. Saket Patwari. Dear friends, on behalf of the German Engineering Federation, I would like to thank Mr. Doshi, Senior Executive Director, and also Mr. Saket Patwari for the excellent presentations, and I'm sure US participants would have immensely benefited on the new topic of MLI, multilateral instruments, as well as the GST across. Dear friends, my colleague spoke about the new GDP, results that are out. The Indian industry and the government should now focus on action-oriented policies. The top 100 out of the 700 districts that were most badly hit by the COVID-19 had 77% of the total COVID cases and were responsible for 50% of the GDP contribution to India. So recreating growth in the near term is likely to come from sectoral strategies across at least the top 10 key sectors which are contributing mostly to the GDP. The dormant resources that exist from the enterprises, the industry, government must be put into service, requiring special focus on improving the balance sheets. As an example, targeted investments by government in platforms will be of most important as a revival approach. As government resources are directed to digital and physical platforms, deeper and wider, these will inject much needed money into the economy in a targeted manner. A typical example would be like a GST, more generalized, or currently the UPI that has come into practice. Taking pre-COVID-19 view, India's economic potential measured on a 5-year average was 6.8%. Going forward, using such developed platforms, bringing all segments of the society, industry, people, everybody on deepening, widening, heightening, formalizing, and further digitalizing the economy, India's full potential can be an average 9% or more. By shifting to this full potential trajectory, hopefully starting the next fiscal or a subsequent decade, I'm sure India can pull out all forms of from the current economic crisis and move ahead in full throttle. But courage, foresight, and determined action are needed to achieve this in big dollars. Dear friends, the legendary Steve Jobs of Apple had always said, you cannot connect the dots. You cannot connect the dots looking forward. You can only connect the dots looking backward. So you have to trust the dots, and that will somehow connect in your future. So friends, stay hungry, stay foolish. And I now thank our panelists from SKP for the wonderful presentation and the excellent participation from our invitees across. And friends, thank you for being present. Please stay well, stay safe, stay optimistic, and wishing you all a good day ahead. Thank you very much.
Thank you.
Thank you. Thank you.
Thank you.
Thank you.